Welcome to the M3 Report, your show for metals, markets, and money. I'm your host, Dave Russell of goldcore.com, the leading precious metals dealer. And the M3 Report takes an irreverent look at financial markets and the doublespeak of policymakers to help you better understand exactly what's going on with your money. This is our second episode, and last week our special guest was Jim Rickards, and we talked about perception and how policymakers in government, or even our own central bankers, continuously attempt to manipulate our perception to suit their own agenda. Coming up in this episode, we have Dr. Marc Faber, editor of the Doom, Gloom and Boom report, talking to us about the rock and the hard place that the Federal Reserve and all other Western central banks find themselves in. Then we have Gareth Soloway of InTheMoneyStocks.com joining us once again in Chart Watch, where he'll give us a roundup of exactly what's happening in the gold and silver markets, as well as anything else that's grabbed his attention. And a new feature, Sign of the Times. This is where we'd like you to get involved. Send us tweets, news stories, or even anecdotes that say something about the times that we live in. This week has been chosen by a member of our own team at Goldcore TV, but we'd love to include your stories in future shows. And finally, stay tuned for Trading Places, where we ask a series of past guests what they would do if they were in Jerome Powell's shoes. What we're now seeing is that the too few goods part of the equation can also be impacted by government policy, government incompetence, and inaction. The government's response to COVID globally, Brexit, war in Ukraine, and climate initiatives like the Green New Deal, the Keystone Pipeline debacle, drilling licensing, and the reduction in refinery capacity have massively increased supply chain issues and the access to essential commodities like oil, natural gas, and foodstuffs. This is cost push inflation, and it's hit us like a train. When the money supply has been increased, then this results in demand pull inflation. And when government policies results in a shortage of goods and services, this results in a cost push inflation. Ultimately, they're both caused by the hand of government. Both are bad news. And it's particularly bad news when we have both at the same time. And that's where we find ourselves today. Those who are supposed to do something about it are the very same people who caused it in the first place, who then told us we were worrying about nothing and have now admitted that they don't understand it. And therefore, they don't know how to deal with it. Which makes me wonder, amongst the futility of inflation, are we really looking at the futility of central banks? Because these are the central banks that want to use monetary policy to fight inflation. But why would you use monetary policy to fight cost push inflation? Cost push inflation cannot be fought with something that controls the price of money, because this is not about money. No, this is about disrupted or broken supply chains caused in large part by extraneous factors such as a war between Russia and Ukraine, a pandemic, labor shortages, and of course, ill-conceived, ill-informed, shoot yourself in the foot government policies. So how are central bankers going to respond to the problem that they now have before them? Well, this is exactly what I asked our special guest this week on the M3 Report, Dr. Marc Faber of the Doom, Boom and Gloom report. Marc Faber, welcome back to Goldcore TV.
Well, thank you very much for having me on your program.
It's great to have you. Now, there's a question that I saw on Twitter this week, and it really kind of piqued my interest, and I want to pose it to you. When something like this, it says the Fed are facing two options. Option A is keep raising rates, sell bonds, and allow the Great Depression 2.0 and 30% unemployment. Option B is quantitative easing to infinity, 0% rates, allow inflation to run hot at 20% plus with stagflation and destroying the US dollar. My question is this: are there any other options? Which one of those is worse, and which one will they choose?
Well, we don't know what they will choose, but whatever the government does is usually a bad choice. They should leave most of the economic matters to free markets, to individual decisions, and to the capitalistic system, to what we had to make essentially the Western society prosperous over the last 200 years. Now, over the last 100 years, we had the shrinkage of the private sector and an expansion of the government sector. And as this expansion of the government sector lasted and became more and more interventionist, the economic growth obviously slowed down. So if you look at Britain between 1800 and 1900, or the US between 1800 and 1900, it was much stronger economic growth in terms of personal income gains in real terms, whereas in the last century, the 20th century, economic growth has slowed down. And over the last 40 years, for most people, I'm saying most people, there has been no progress in economic prosperity, in the standards of living of individuals. And that is essentially the interventions of government officials, most of which pursue their personal interest and not not what is good for society. And regarding your question, what is the least bad option for the Fed to proceed from here on? I'd say the best option would be to close down the Fed, to abandon the Fed. That all these people that we have at the Fed for the last 30, 40 years are money printers and nothing else, interventionists with a lack of knowledge of history and of social sciences. And they all, the last three Fed chairmen, they all subscribed to Milton Friedman's theories, but they took it out of the context of Milton Friedman, who always argued for small government, for non-intervention, and actually argued that a computer would do a better job than the Fed officials that print at the wrong time and tighten at the wrong time, and actually make matters much worse. So, having said that, I think the worst possible option today for the US would be to print money. By tightening the screws, it is far from certain that unemployment would soar to 30%. We will have a recession, but the recession is overdue anyway. It would have happened in 2019, 2020, but then they flushed the system with a huge liquidity bubble that prolonged the artificial expansion of the US, but also led to higher debts and to higher inflation rates. And Milton Friedman was very clear about this, that government spending that is financed by an expansion in the quantity of money is inflationary. And they all read Milton Friedman. Bernanke, he had a speech when Milton Friedman turned 90 and said, oh, we will not let another depression occur. But Anna Schwartz, who wrote the monetary history of the United States with Milton Friedman, she then criticized Bernanke. She was right.
So if we bring it back to inflation and money printing, what are your thoughts there?
If they print money, assets can go up, but maybe not in real terms.
Indeed.
You understand? The stock market could go ballistic up. The gold could go up even more. Bitcoins could go up. And the standards of living under any scenario, I'm quite sure will go down. With the policies that the politicians pursue, and I have to stress once again, I was thinking just now, because I've read quite carefully history, and of course history is so large, it's very difficult to know everything. But I have to say, when I look at the Biden administration, at the administration in Germany, even in Britain, and Trudeau in Canada, I mean, what a complete joke these people are. It's all it's all fake, it's surrealist. I mean, it's hard to believe that a more incompetent group of people could be taking these major decisions.
And
Just
you see,
look at the energy policies of Mr. Biden.
indeed.
That just recently goes and blames the people at the pump that the price is high, they should lower the price. Why are they high? Because he pursued energy policies, turning off the leases on federal land. And the day one he came into office, he immediately stopped the Keystone pipeline.
So this is a no-win situation then. Where do we go from here?
In my view, we have postponed economic corrections for far too long. We had the opportunity to clean the system in 2007, 2009 in the great financial crisis. But they immediately said, well, if we don't bail out this and don't bail out that and don't print money, we'll have a depression. I don't think it would have been a depression. It would have been a serious recession. But in adversity, people learn. If you keep on bailing out people, you reward essentially zombie companies that should go out of business, and you penalize the conservative, prudent businessman.
And just to step across to another major topic here, the war in Ukraine. Do you see an escalation in Europe or hotspots elsewhere?
Well, when Mr. Biden tells the world that this Ukraine conflict has solidified NATO and so forth, that is questionable, that statement, because some NATO countries are not entirely on board and some have different views than the US. But maybe what he says has some grain of truth. But equally, close to 90% of the world hasn't sanctioned Russia. They are actually very careful to adopt the Western alliance view. By Western alliance, I mean principally the US, Great Britain, Canada, Australia. These are the Western leaders that then essentially use Europe to enlarge the conflict. But 80–90% of the world's population is not on board.
Mm-hmm. Now,
and I think whatever the crisis, whatever way the crisis will end, I can guarantee you that the American prestige, I grew up in the 50s. We admired America in the 50s, even in the 60s. In the 70s, some question marks arose because of the Vietnam War. Nowadays, I think most of the world has a low opinion of America.
Do you think one of the biggest developments that we've seen this year around the war is the idea of weaponizing financial assets? Do you see that as a huge mistake by the US in particular? One of the reasons that I ask that question is because you've got the likes of China, who are massive holders of US treasuries, and they've seen what the US has done to Russia's, or attempted to do to Russia's dollar assets. And as a result of that, they're maybe looking long and hard at their own balance sheets and saying, we don't necessarily want to be holding the same amount of US denominated assets as we have in the past. And as a result of that, kind of ushering in this era that may see, or that will see an end potentially to US financial dominance. Does that sit with you?
Well, I think the reserve currency status of the US dollar, regardless, is going to come to an end. because there's much more trade between, say, China, Europe, China, the rest of the world, Africa, Latin America, than between China and the US. There's also much more trade between Africa and India and Africa and Russia and so forth than towards the US. You understand?
Yes.
The role of the US dollar is going to diminish. And in my opinion, the seizure of assets from Russia is one of the dumbest policy decisions you could imagine. First of all, but the Europeans don't see it that way. The Europeans think, oh, we go with America is a great thing to do. Actually, ordinary Europeans don't think that way, but the politicians, because the politicians get paid also left, right, and center by all kinds of charitable institutions, believe me. And but the individual in Europe, he says, I'm a farmer in England, I'm a workman, I'm a carpenter, I'm a plumber. What do I care about the eastern territory of Ukraine? It's none of my business. I care about my cost of living. I want to have access to food and to energy at reasonable costs.
What's the best piece of advice you've ever got?
To shut up.
My thanks to Dr. Faber for joining us. And if you want to see the whole interview, then be sure to subscribe to Gold Core TV and you'll be alerted when it goes live. Next up, we delve into technical analysis for Chart Watch with Gareth Soloway of InTheMoneyStocks.com. Gareth, what are the charts suggesting are in store for gold and silver, and what else should we be keeping an eye out for at the moment?
Hey, Dave. Thanks for having me. So what we're going to do today, folks, is look at the dollar chart. And the reason why the dollar chart is so important today is because it looks like we may be getting a near-term top in the US dollar. Now, if you've been following the US dollar, you know it's been soaring all year long, recently spiking dramatically. The euro has been collapsing to almost par against the dollar. Now, the key here is what I'm seeing in the charts today. So let's dive right in, folks, and take a look at the charts. So this is the daily chart of the DXY. What you can clearly see right here is we had an initial spike up and we've reversed the gains and are basically flat on the dollar. Now, some of you might say, well, what's the big deal? Well, this is the big deal. Number one, we had the jobs data here on Friday morning. The jobs data was very, very good. That usually would cause a spike up in the dollar. The dollar did spike higher intraday off of that news and then reversed. In the history of all my trading, in the 20 years that I've traded, what I found out is that when good news comes out and something initially spikes and then reverses, it tells you big money is selling into it. So that's what we have here. We have big money likely dumping into that good news on the jobs report, and that is a bearish short-term signal. In addition, this may be creating a topping tail on the chart. All right. So a topping tail is a bearish technical signal that tells you a reversal is at hand. Now, as if that's not enough, flip over to your monthly chart on the dollar. This is the DXY. This is going all the way back to 1999 to 2000. And let's put some trend lines in here for us to try to figure out. So the first one I'm seeing is take a look at this line here, right? So you have a defined line right here. What we can do is we can connect this right through. All right. So again, look at how here's a line. You kissed it right here. You kissed it right here. You pierced it here. And then this is where the dollar topped out this morning. So that's number one. Then take a look at this little pivot going back to 2000 and also this little pivot high. And again, I know it's hard to see here, but there's a low and there's a high. That's telling me there's a support resistance line in there. When price is below, it is resistance. When price was above, it would be support. Now, if we put that line in and draw it right across, basically that's within the range of what we're currently seeing. So there was a ton of resistance on the dollar. You couple that with the reversal off of the jobs data today, the topping tail, and to me, this spells trouble for the US dollar, at least in the short term. Now, what's that? What does that mean? I mean, what does a weaker dollar mean? Let's say for the next month or two, if we see a pullback in the dollar. Well, actually, what that means is that's very good for metals. So gold, silver, platinum, anything like that should get some sort of bid. I think silver, platinum, and oil will have trouble because potentially a recession would be bad for the industrial side of those metals. But for gold, that would be very, very positive to see a pullback in the dollar. I also think that you have to look at Bitcoin. Bitcoin has already started to uptick. It's held its 2017 highs. And ultimately, I think that makes sense that that could be a potential short-term move. Now, I want to be clear. I still think Bitcoin has another leg down, but I think you could get a move to 25,500, maybe as high as 28,000 before that next leg comes in. My downside target on Bitcoin remains 12 to 13,000 before any real chance of a longer term bottom being put in. All right. So again, the bottom line is today, for the first time, we're seeing a confluence of major resistance levels hit on the US dollar, the DXY, and we're seeing a potential topping tail. And we also saw a sell the news event on the dollar in relation to the jobs data. That right there has me accumulating gold, silver, as well as some Bitcoin down here. I think you look for a near-term pop. And I stress this, folks, we're not talking long-term trading here. This is a near-term move that likely will see a couple-week up move in those commodities in Bitcoin. And again, I think that could be a short-term bullish signal for that, even the stock market potentially. All right, have a wonderful rest of your day. Take care, Dave.
Thanks for that, Gareth. And there certainly was plenty in there for us to take into next week. And be sure to let us know if there's anything you'd like Gareth to look at for the next episode of the M3 report. Now, Gareth talked a lot about gold and silver because that's our area of interest. Goldcore is your precious metal specialist. We're here for all of your gold, silver, platinum, and palladium needs. From gold Britannias to silver eagles, from fully allocated, fully segregated gold coins and bars, stored in specialized high security vaults around the globe, we've got you covered. Simply head over to goldcore.com now and sign up to get started. My colleagues are a friendly bunch and are happy to answer any questions that you may have. And still to come, stay tuned for Trading Places, where we ask a series of past guests what they would do if they were in Jerome Powell's shoes. And now for a sign of the times. A member of the Goldcore team spotted this a few weeks back. How about this for a headline? If you have a basket instead of a trolley, you can't carry as much. Therefore, you spend less. It also means you're more conscious about what you're buying, as you don't have as much room. Now, this might be true, but the sad fact is that the majority of people feeling the pinch don't have the option to buy less food. They still need the same amount of food because they still have the same number of mouths to feed. This is how desperate the times have become. And that brings us to the end of this week's M3 report. If you've enjoyed the show, had a nap during the show, or want to share the show, please let us know, either in the comments below or by tweeting us at Goldcore, or by using the hashtag TM3R. That's all from me, Dave Russell, and I'll leave you with our esteemed guests in Trading Places, the feature where we ask a series of past guests what they would do if they were in Jerome Powell's shoes. Now, we left out the one answer where the guest responded, "I'll shoot myself," but as you'll see, positive answers these are not. Be sure to like, share, and comment on this video just to let us know what you thought. And don't forget to hit the notification bell to get notified for the next episode. Until the next time.
He is damned.
I would quit my job and go to work for Citadel.
And I said I would resign. I would just I would resign and say, okay, this is the experiment in a 100% fiat currency has failed miserably. We destroyed the economy and destroyed the middle class over and over again. So this is what we're going to do. We're going to either go back on the gold standard or limit the growth rate in base money to the natural increase of the labor force plus productivity, so GDP. So think about 1.5% to 2% annual increase in potential GDP. So a 1 or 2% increase in the base money supply, and let markets decide where interest rates should be. The supply of savings versus the demand for money. But how about let markets work? Let the market figure out where home prices should be. And they shouldn't be up 80% year over year in Florida or 20% year over year all over the country. It doesn't make any sense. Let the market decide where where equity should be. Let the market decide which companies deserve to stay in business and which should go the way of the dodo bird. Because you shouldn't have companies being able to borrow money for free just to borrow money so they can pay interest on outstanding debt. It's not a good proposition.
Well, my immediate inclination would be to resign.
I would use the combination. I had to work with the Treasury a little bit, but I would use the combination of the gold in Fort Knox and a lot of us at West Point and the Fed's printing press to make a two-way market. So just set a price for gold significantly above where it is now, at least $5,000 an ounce, but probably higher. And just say, hey, if you think that's high, sell it to us. We'll pay you with dollars that we print. And if you think it's low, come and get it, back up the truck. In other words, but if you do that, if you have the gold stash and the printing press and you get the price right, you can make a two-way market and maintain the price. And that would be a way to restore confidence in the US dollar.
Well, I would never allow myself to be in Jerome Powell's shoes. So I'm not sure I can answer that. I think I would be looking to hand over the reins to someone else. That would be my simple answer. Get out of Dodge.